Hey Ryan. Hey Christina.
Hello, how's it
Hi,
going?
Chris.
Good. How are you guys?
Doing good.
Good, thank you.
Good.
I'm at
Enjoy.
work, or I would have my camera on. I'm sorry.
No, no worries. No worries.
I'll say hi real quick. Hi.
Thank you. Hi Christina. Thanks for taking your camera off. And no, I get it. It's kind of a dark and gloomy day, and so I really didn't want to come in, but I'm here.
I have this going on over here.
What's up, Ryan? Oh, there you go. Okay.
Got my hands full
Yeah, they'll keep you busy, I'm sure.
for sure.
I gotta admit though, I'm not a fan of that flag behind you.
Yeah, I figured so. I know you're a diehard Denver fan.
Yeah, yeah, that's me. But I don't know. I saw an article a couple days ago that said Denver was like one of eight or seven or eight places that LeBron's new destination might be. And as a pure Denver fan, I'm really hoping that's not true.
No, I don't. I think it's either he's staying in LA or he's retiring. I don't really. It don't make sense for him to go anywhere else at this stage of his
No,
career.
no, in LA, I mean they did it right by, drafting his son and doing that stuff. So that was pretty big, I think.
Guess we'll see what happens this summer. It'll be interesting for sure.
Yes, sir. Yes, sir. All right, guys. Well, we'll give it like 30 more seconds, then I'm gonna go ahead and get started here. And we'll go from there. All right. All right, we're gonna get started with the huge, the one I always like to get started with by our good friend Logan, and just a general run through of the housing market where it's at this week. So, as we get started here now, what he kind of talks about in this first paragraph is stuff that I typically don't touch on, but it's around the 10-year yields and whatnot. But ultimately, what he's saying is the mortgage rates and the 10-year yield have both reached yearly highs. Now, the bond market volatility is tied to obviously the Iran conflict, the oil price concerns, things that we're seeing there. However, he finishes it off with saying, despite the higher rates, the housing demand indicators are still staying slightly positive. So, with that, what he is mentioning here is that the mortgage spreads have improved to 1.92%. Again, don't ask me what that means necessarily, but they've improved, which is the key word there. And without better spreads, he did mention that mortgage rates could be between 7.27 and 7.84 if that mortgage spread, is lower or not as improved. Um, so the improved spreads are helping prevent a major slowdown in housing activity. But ultimately, what it means is that the housing demand is proving resilient even under pressure, which we've talked about the last couple weeks. The rates above like the 6.64 up to 7%. That's typically historically when we see a weakened demand. But the current market activity would likely be much worse without the healthier mortgage spreads. So that's ultimately what he has to say about the mortgage spreads specifically. But he does feel that those are a driving factor in why our market's still moving. Um, so as we get down here, we'll pass this mortgage spread stuff. So we'll hop into weekly pending sales now. So weekly pending sales, we did see an increase year over year, which at 78,006 versus 73,523. So we are still showing positive year over year growth there. The market is currently sitting at the seasonal peak period for pending sales. So the demand is holding up despite the elevated mortgage rates. Again, easier year-over-year comparisons helped with this week's growth, but the mortgage rates continue to be the biggest driver of the housing activity. So again, something to keep in mind that's mentioned here is above 6.64 to 7%. Typically, we see that historic demand weaken historically, and then under 6.25 is usually when the strongest housing demand is something we see there. So the pending sales do remain resilient, but the rate sensitivity is very real for buyers out there. The future weeks will matter more as the comparisons get a little tougher. Um, and again, something just to keep in mind, pending sales today does equal closings in the next 30 to 60 days. So it is kind of a forward-thinking data point there. So the demand is still positive, but rates continue to kind of control the speed of the market as we're looking at the pending sales. And when we look at this graph here, what we are kind of seeing again is we are over the year over year, kind of declining as of right now from last week. But again, we've got the increase year over year there. So as we get to mortgage purchase application data, now again, keep in mind that this is also a forward-looking indicator 30 to 90 days ahead of sales. But what we're seeing here is that the purchase apps have increased 4% week to week and 7% year over year. So again, if you notice in this graph here, we are above last year as well. So the positive demand does signal a continued overall growth in 2026. Um, and also keep in mind that this data was collected when mortgage rates were slightly lower. So buyers are still active despite the affordability pressure that we're seeing out there. The purchase apps do remain one of the best forward-looking indicators because obviously if people are still submitting those purchase applications, then we're obviously seeing that the buyers are still interested in at least getting started in the process. So as we look at this trend, overall, what we do like to see, I think he mentions it here, is we do typically want to see at least 12 to 14 weeks of positive week-to-week data. In the last 12 to 14 weeks, we're seeing 9 positive weeks, 16 positive year-over-year weeks, but overall the demand is still slightly positive despite the volatility. So the buyer demand has not disappeared, but again, with the affordability pressure that we're seeing, it is building as well. The rate movement will heavily influence the next phase of the market. So we'll just watch this closely and kind of keep an eye on it week to week like we've been doing. Now, as we move down into housing inventory, so what we're seeing with housing inventory is that the inventory does continue, or the growth is continuing to slow down, but it still does remain slightly positive year over year. It's about 1.38% if we come over here. So we are still slightly positive there, and the inventory still increased week to week as well. So we went from 767,132 to 777,913. So the market shift that began in 2020, in mid 2025, is still playing out, obviously, there. Now, obviously, lower mortgage rates help keep the demand stronger, and also slow the inventory growth. But the massive inventory growth from last year, which was about a 33% peak, was really never likely to continue. So again, going back to the cliche statement, I feel like I've said consistently, it's not a crash. It is a normalizing market. We're normalizing from last year and the years previous. So supply conditions are stabilizing instead of rapidly expanding. But ultimately, like the big picture in this inventory level is it does still remain at a multi-year high. The market is still far healthier than the ultra tight conditions that we experienced in 2020 through 2023. So even if inventory briefly turns negative year over year, the supply is still much improved overall from the years previous. So um, again, with this, I think context matters more than the headline, something that we always consistently talk about. But the slower inventory growth does not mean that the supply is collapsing by any means. The buyers still do have more options today than they did in the pandemic years, and that's something to note for sure. So as we move down to new listings, so what we're seeing here in new listings is they did come in at 78,000 versus year over year or last year's 76,112. So it is a slight dip after recently breaking above the 80K mark. But again, it's still higher than this time last year. So um, seller activity is improving, but it hasn't fully returned to normal levels yet. Obviously, that's something we're seeing. And the seasonal peak periods, what we typically like to see is around 80,000 to 100,000 weekly listings. So we're just below that threshold there, but the market is continuing to show gradual normalization and not an oversupply by any means. Now, something to note here, important context, the housing crash years that we've seen, they saw 250,000 to 400 listings per week. and we're nowhere near that. Post-COVID peak only reached about 91,000 in 2022. So the current supply levels are again nowhere near crash, the market crash era conditions. So more listings today are a healthier sign for the market. Inventory growth is creating opportunities without signaling a collapse. And then watch closely for that sustained 80K. Again, that in this seasonal peak time, we're kind of looking to stay at or above 80,000 as far as the new listings go. So today's inventory growth is normalizing. Again, I can't express that enough, but it's nothing nowhere near anything close to the housing crashes that we've seen. So as we dive into price cut percentage, now typically, rule of thumb, keep in mind we typically see most homes on the market. The national average is about 33.3% of homes will have some sort of price reduction. So right now, the current price cuts are sitting at 36.5, which is about a 0.5% lower than last year's 37%. So for most of 2026, the price cuts have remained slightly lower than last year, and we can kind of see that here on the graph. Um, Now, pricing conditions do remain relatively stable overall. The lower mortgage rates earlier this year help support the pricing, and then the rising mortgage rates could create more pricing pressure moving forward. So something to watch there. But ultimately, like a takeaway from the price reductions here is the pricing strategy does matter, and it matters more in today's market than it did, yesterday's market or last year's market. The sellers do need to have realistic expectations from day one, which is that conversation with an educated agent like ourselves. And then price reductions are normal market behavior. I mean, that's just the market telling you, hey, you're overpriced and you need to drop it. So, again, having the conversation beforehand, getting a plan of price reductions or price improvements, however you want to state that. But having that plan with your seller just in case so you're not chasing the market is huge. So, that's all I've got for this article, but again, I always like to dive into that one first just to kind of see what's going on in the world of Logan. So now as we hop over here, I've got this next article here. Now this is Errol Samuelson on Zillow, Compass, and a growing MLS trend. Ultimately, what this article is talking about is the current fight going on, I guess, between Zillow and Compass. So Zillow is actually suing Compass and several MLSs over private listing practices and listing access rules. Now, Compass has expanded significantly through acquisitions over the last couple of years, and they've taken a pretty big market share with Compass. They've got obviously Coldwell Banker, Century 21, and Live Sotheby's. So the debate kind of centers around who controls listing visibility and access. Now, what's the real issue in this article, or what's mentioned in this article as a real issue? Well, Zillow argues that the MLS system works because the listings are transparent, cooperative, they're publicly accessible, and they believe that selective private listing strategies does reduce the competition and consumer transparency. Now, Compass, on the other hand, believes that more control over they have more you have more control over the listing exposure, your expanded private marketing strategies, and then you're creating exclusive inventory access through the brokerage ecosystems. Now, from our perspective as the agent, some questions I guess to think about is could the MLS become a market of last resort? If listings stay private first, are the consumers no longer seeing the full market in one place? And then the risk of information asymmetry, where some companies control more market knowledge than others. Um, that's, kind of the industry concern there. Now, as Keller Williams, one thing I'll say is, again, we are a tech and training company that does real estate, and they're always thinking about this stuff ahead. So, we always got one thing to keep in mind is we always have to keep our buyer and seller first. The focus should stay on transparency, education, and explaining the trade-offs clearly of a private listing versus out on the MLS. This is ultimately becoming a battle over inventory control, consumer access, and the industry influence as well. But to take away from this, and I'll dive into it in the next one too, but I mentioned Keller Williams is always thinking about this stuff ahead. Well, we actually do have a new partnership with Cotality, and their Cotality is launching the BLX through Keller Williams and then also Home Services. But that essentially to combat this, down the road, there's a good chance we could see if the MLSs do start to go away, we'll have the ability to, with Cotality, to be able to input our listings directly into Command, and that it's the same way building it out like we do through the MLS. But then we'll be able to toggle where we want this listing to go. So if we want it on Zillow, Redfin, well, there will basically be a list of toggles. We can submit it to the MLS and things like that. So that they're already in the process of coming up with ideas to combat this private listing, exclusive listing market. So we'll just keep an eye on where that goes. But ultimately, I mean, to take away from this article, I would say that consumers may become confused by the shifting listing visibility rules. So we need to be able to clearly explain how exposure impacts the competition and pricing. And if we can explain that to them about, maybe if it's a private or exclusive listing, well, that's all great and dandy, but you're limiting the exposure of who's going to be able to see this. So you have to be able to explain that to your sellers and to your buyers as well. Regardless of the industry battles, though, the client trust and education is going to be the real priority there. So just wanted to bring that one up here. Now, as we move over to the next one that I mentioned, it's Cotality BLX. Cotality launches broker listings exchange with KW and home services. So what this article is talking about is Cotality did launch a new platform called the Broker Listing Exchange, the BLX. Keller Williams and Home Services are the first major brokerages to use it. Now, the platform gives brokerages more direct control over listing creation, syndication, distribution, and data management. So, what does that mean? Well, agents, again, us, will soon be able to manage our listings more directly inside platforms like Command. And then it reduces the duplicate entry between the systems, and it gives brokerages more flexibility over where the listings appear. So, again, I think that's pretty huge. With everything that's going on, where the real estate market is heading with the MLSs, it's entering a new era of data control and platform flexibility. Brokerages obviously want more ownership of their listing data instead of relying entirely on the MLS's systems or its portals. So the technology is moving toward a more centralized one-stop shop experience is essentially what this article is talking about. Now, from our angle, our leadership position this is a major advantage. And it really is because again, they're just trying to stay ahead of the battle that's going on out there. So the goal is to create better listing management, faster workflows, and more exposure control for clients. And again, that's going to be something where you sit down with your seller and you say, okay, well, where do we want to syndicate this listing? And if it's everything, great. Or maybe the seller doesn't want to be on, third parties like Redfin or Zillow. Well, then you would keep those toggles off. It is how it should be or how it was explained to me. So, and then the other cool thing is Lone Wolf, which now operates Command as well, is actively building upgrades and improvements to the platform also. So something just to keep in mind, MLS systems are still critical. It's not like they're not, and they're not just going to disappear overnight. This is more about increasing the flexibility and reducing the friction, not eliminating the MLS participation. So technology and listing management are quickly evolving, and what we're seeing there is the agents who adapt early to the new systems and tools will gain efficiency advantages. So understanding how the syndication works and the listing distribution is super important. And again, I think that's just having those conversations with your sellers right off the bat. So the future of real estate tech is about giving brokers and agents more control over their own data. Now, as we jump into here, why a 2008 housing crash can't happen again. So, this article, again by our friend Logan, what he's basically diving into is a couple different reasons behind why we won't see the housing crash of 2008. So, the first one is stronger lending regulations. So, after the crash, the major laws changed the mortgage industry. We saw the qualified mortgage rule, we saw the Bankruptcy Reform Act, and these laws basically force lenders to verify borrowers could actually repay the loans. It also reduced the risky lending practices that were going on before this market crash, and it prevented the extreme over-leveraging seen during the bubble years. Now, the other piece that we're seeing is the 30-year fixed mortgage dominates. So before 2008, it was the adjustable rate mortgages, the ARMs that were exploding, and the payments could suddenly spike on those. Many borrowers qualified for homes that they couldn't truly afford. Today, most homeowners are having a stable 30-year fixed income fixed loan. And the payments stay predictable with that. Obviously, they're not fluctuating up and down. So the higher average FICO scores and stronger borrower quality. So overall, it's just we're in a better situation and with the lending piece of it. Now, the homeowner equity is dramatically different than today. In 2010, over 23% of homes were underwater. Today, homeowners hold massive equity positions. So even in hardship situations, many sellers can still be profitable or still sell their homes profitable instead of facing foreclosure. And also, foreclosures today are not like 2008. The foreclosure headlines that we see are here to create fear, but again, the context matters. The small increase today are nowhere near the crash era levels, and the bankruptcy and foreclosure data do remain historically low compared to the Great Recession. So ultimately, what it means, today's market has structural protections that did not exist before 2008. So it's not the same, lending qualifications and things like that. The small ink, most homeowners are financially stronger with fixed rate mortgages and the higher credit quality, and then the significant home equity as well. So even if the prices soften in some areas, we don't have the same widespread risky debt environment that caused the great financial crisis of 2008. The current market reality, I would say, homes may sit longer. Again, have that conversation with your sellers, but the price growth may slow, and then some sellers may need reductions. But that does not mean it's a housing crash. The market is behaving more like, again, a normalized market, a normalized period, a higher rate adjustment cycle, and a supply and affordability challenge, not a credit collapse. So ultimately, take this information, educate your clients using the facts, not the fear-driven headlines. Help your consumers understand the difference between what a market slowdown is and what a financial system collapse is. And then the buyers and sellers need to have confidence and context right now. So again, just being on this call, listening to it, hearing what's going on, and then taking that to your clients is going to help you in the long run. But overall, like with this article, the biggest thing I would express is that 2008 was a credit crisis. Today's market is an affordability and an inventory challenge, not a lending disaster. So this one I did not have access to anymore. I tried to refresh it and it did not work. But ultimately, this is 15 housing markets with the biggest home price decline since the pandemic boom ended. And what we saw in this article is that some housing markets are now seeing prices 10 to 28% below their 2022 peaks. The biggest declines are mostly in Florida, Texas, and then the Mountain West markets. So something that we're seeing. Denver and Boulder both made the list. Boulder was 11.8% and Denver Metro was 10.6%. Now, the reason these markets soften, though, again, having the context and not just reading the headline, during COVID, it was ultra low rates. Remote work migration, everybody started working remotely, and the massive demand spiked, which pushed prices far beyond the local income growth. Then conditions changed. In 2022, the mortgage rates surged, the migration slowed, the affordability pressures increased, and new construction supply expanded in the Sun Belt markets. So some formerly hot markets had to recalibrate. Now, builders also changed the game as well. And in this article, a lot of the Sun Belt markets, the builders offered incentives, price reductions, and rate buydowns, which created more competition for your home sales and added downward pressure to pricing. Now, something important to note here, it's not a national collapse. Nationally, home prices are still above 2022 levels. The wages have grown faster than prices recently, and some markets have already started seeing stabilization and renewed growth. Also, many Midwest and Northeast markets remain very tight due to limited inventory and less overbuilding. So what does that mean? The real estate, again, is hyper local right now. Markets that overheated the most are correcting the most. And some price declines are actually reducing long-term market risk and improving affordability balance. So, I mean, for those of you that were around during the COVID years, it was nuts and prices skyrocketed. So, while we're seeing that now level out and come back, it's just normalizing. It's not dropping below, where we were 2 years ago or whatnot. It's just normalizing from the big burst that we had during the COVID times. So don't let the national headlines define your local market story. Again, it's all hyper local. Each market's going to be different. Help your clients understand the difference again between a correction and a crash. And then the opportunities still exist in adjusting markets for both buyers and sellers and investors. The hottest pandemic boom towns are cooling the most, though. So obviously, cooling, though, is not the same as collapsing. Having that context to be able to discuss with your sellers is huge. Um, all right. So now that's all I have. I did want to see, is David out there today?
Hey, Chris.
Yes, he is. All right, I'm going to stop sharing. I brought David on today again because he's always got the best information and sometimes the best fun facts. But go ahead, David, take it over and tell us a little about your world.
Oh, all right. Well, thanks, Chris. Yeah, I don't really have any fun facts, I guess, today. So I saved those for the team rally. But
I just like putting you on the spot.
I don't know. If you want a fun fact, though, I think Colorado homeowners rates are sixth highest in the country. I don't know how
Ooh.
fun that is, but it's a fact. Anyway, so what I was going to talk about today is basically last year. There was a House bill that passed, and it takes effect in July 1st. And it's basically, it requires that insurers provide written notice of your wildfire score. So I don't know how many of you are active in the mountains and the foothills in that area. But over the last several years, it's been difficult getting coverage. Each year it gets a little more limited. And so what it came to was basically that, clients, consumers were upset. They were getting declined based on territory. And then if you add in personal components where maybe they didn't have the best credit or whatever, it was another block for them. So basically, the idea behind this is to add more transparency. Gives you a wildfire score, the factors in that area, how far away the fire department is, if it's a volunteer fire department, how many tanks they have, what's their water gallon capacity, things like that. And so it also allows you to appeal your wildfire score, right? I mean, insurance company use, third parties that come up with these models, and maybe for whatever reason something got overlooked, or maybe it just hasn't been updated, and that it's a better wildfire score than what's showing. You can appeal that, and then also insurance companies have to provide discounts, or what available discounts there are. It's kind of funny, in years past it seemed like it's kind of in the you get it, you bind coverage, the insurance company comes back and says, oh, well, you can have coverage, but now we need 100 feet of mitigation. Well, you didn't know that going in, and all of a sudden they want you to cut your trees down, which is kind of why you're in the mountains. So it was always a pain point, I guess. And so hopefully a lot of more things are disclosed to where what you have to do with certain insurance companies. Like I said, for the most part, they're kind of standard now. They all kind of have similar requirements, but there definitely are companies that have different requirements than others. Okay. Mitigation is clearly a big one, right? They don't want trees on top of your house anymore. That's just a fact, right? Especially with all the wildfires that we've had recently. So I guess along with that House bill, Colorado also has in the works, and now it's effective, is something called the Colorado Fair Plan. What that is, and basically if you go to their website, Colorado Fair Plan, it's a insurance of last resort. Okay, it actually says on their website, last resort coverage option. If that doesn't tell you something. And they say that because you do need at least 3 declinations from insurance companies in order to qualify. But you are absolutely not going to go there unless you have to. The coverage sucks. The rate sucks. Sorry, there's no other way to put it, right? It is actually last resort. The coverage amount goes only up to $750,000 for a dwelling. and that's actual cash value, which is not replacement cost. Actual cash value basically means that depreciation is involved. Okay. So they're going to look at the dwelling, they're going to factor in the age and the material, and that's your actual cash value. Okay. So it's much worse than replacement cost. And with that, you only get coverage for fire and lightning and smoke. Um, Nothing else that's is included in there, theft, vandalism, all the other things that are included in a standard homeowner's policy. It's just basically a fire policy. Um, and so it's an option, but it is the last option. So just know that. But I mean, they basically did that because, a lot of those mountain properties were just uninsurable and nobody would take them. So this is more or less a state sponsored policy. And with that, not a lot is provided more than fire damage. So um, if you're interested more on that, I can get in the details if you really want to know about that. But like I said, unless you're really active in the mountains, you're probably not going to come across it. And hopefully, if it's in the foothills area, there'll be a standard carrier that will be willing to write the insurance on that. So, does anyone have any questions about anything?
Doesn't sound like it. Sounds like you're
Okay.
ready
Well,
to
yeah.
use
So
your
that's
day.
all I got. Yeah.
I
Like I
got a
said,
little
if
something.
Oh,
I,
Ryan's got something, David.
yep. Go ahead.
I guess I just recently found out my mortgage payment went up due to taxes and insurance. Would it be a good idea to just shop around to possibly see if it could lower that, or is that just kind of the world that we're in right now?
Yeah, your homeowner's insurance went up because of, is that what you're
Well,
saying?
my
Your
mortgage went up
mortgage payment?
because insurance and taxes is
Yeah, definitely, definitely. I always advise every 2 to 3 years to take a look at it.
okay.
You don't want to be switching every year, but certainly every 2 to 3. It's just to have a good idea on what the market's doing and if you're overpaying or if you're not overpaying or kind of what's going on there. So, and plus, it's a good refresher on coverages.
Okay.
As over time things change, right? And you want to make sure that you're changing with it. So, so yeah, I always advise that.
Okay. I'll reach out to you offline and get some more help from you.
Perfect. Sounds
Thank
good.
you.
Yeah. Any other questions? Great. Well, if you think of something later on, I'm easy to find. I'm in the office pretty much most days. Otherwise, a lot of you have my cell phone. But if you call that office number, you'll get Jade. You've probably been in the office and see that we sit 3 feet apart from each other. Um, so we communicate pretty regularly. So anyway, thanks everybody, and I hope you have a great day.
Yes, thank you, David.
You,
And
David.
they do communicate regularly, except for when it's the Wild versus the Avs. But
Low
awesome.
blow,
Thank you,
Chris. Low
David.
blow.
I couldn't pass it up. No, thank you again, David. I appreciate you taking time today to just hop on here and go through your world a little bit. But seriously, guys, any questions you have, reach out to David or Jade. They'll answer them and make sure they'll also kind of walk you through it, talk you through it like you're in fifth grade if you need it, like I do. So, yeah, they're awesome. But thank you again, guys. I just want to run through one last little. Closing, finishing takeaway here from what we discussed in the articles, and it's pretty similar to the ones we've discussed, the last couple weeks. But if there's one thing that we've seen today, it's that the housing market is adapting. It's not collapsing. So yes, the rates are high. The headlines are dramatic. The inventory dynamics are changing. The tech and data wars are reshaping the industry, and some markets are correcting. But through it all, we're still seeing buyers buy. We're still seeing sellers sell. The demand is still positive. The inventory is healthier than it was a few years ago, and the market continues to prove more resilient than people expected. So, again, what kind of market is this? It's not a hype market by any means. It's a knowledge market, a strategy market, a guidance market. Consumers don't just need someone to unlock the doors anymore. They actually need someone, an agent, who can explain the rates, who can understand the inventory and navigate the technology changes, someone who can calm their fears that are created by the headlines with simple education. and then interpret what's actually happening in these headlines or in these articles as well, in a national but also a local perspective. So the biggest lesson from today is, again, the agents who are going to be winning moving forward are not the ones that are the loudest or the flashiest or the most dramatic, with all their bright signs and colors. It's going to be the agents who are staying informed like you guys, the ones who stayed calm and adaptable and consistent. Because while the average consumer sees chaos, the great agents see opportunity here. So how to win? We win by becoming the local expert, becoming the market expert, being on these meetings about being the market expert, understanding the data that is driving the headlines rather than just the headlines, and educating instead of panicking. And then, I mean, to finish it off with a one-liner, the market doesn't need perfect conditions to create opportunity. It just needs professionals who know how to navigate the imperfect ones. So again, guys, I thank you for hopping on this class today. I appreciate you taking time so that you can be the market expert as well to your clients. Don't hesitate to reach out with any questions or anything. But other than that, you have a great Tuesday.
Thanks, Chris.
Thank you,
Thank
Chris.
you.
Very appreciate you doing this.
Of course, thank you. And have a